So even with the stock market crash in 2022 that took down the S&P 500 nearly 20%, there's loads of talk on the news and here on YouTube that the stock market is still too overpriced, and especially over in the US. And quite a lot of data gets brought up with lots of fancy names and impressive looking charts that seem to back it all up. So then lots of new investors start to worry and think, well, if something looks expensive, we best not buy anything and just wait for a better time. All perfectly rational and normal, right? Why would you want to buy anything that's expensive that you could maybe get cheaper later on? It would be like going to buy a new car, just seeing a huge markup on the sticker and wasting your money buying it right there, even though you could just wait another year or so because there's nothing wrong with your old one. The doors still work, mostly. Now, we all wish we could just time the market and just buy when everything's cheap and then sell when it's at its peak, but that is just not how life works. And actually, that wouldn't work if we all did it, because then there'd be no one to sell to or buy from, because for every transaction, we do need a buyer and a seller. Anyway, saying that, we still don't want to get ripped off and start buying right at the top, so let me just break down what some people are saying, check out the data, and then see if we can get to some kind of conclusion of whether or not the market is actually overvalued, and then what we should do about it. So let me bring up this first one. It seems to have gathered some more momentum recently. It's been nicknamed the Buffett Indicator, but it's actually just a chart that shows the GDP of the US in relation to the value of the stock market. And the reason it was made popular was the big man himself was quoted back in 2001 saying that he thought it was the best single measure of where valuations stand at any given moment. He's since not been as kind to it, so just be warned, he doesn't think that any single indicator is actually useful on its own. But anyway, so as you can see, this is what it currently looks like. Remember that GDP is gross domestic product, and the idea it's a useful measure is that it gives us a good total of value of all of the goods and services inside a single country. Then if we take that amount and compare it with the stock market, it would make sense that we don't want these two things to look too differently, right? All seems logical so far. So at the moment, we're at 164% if we take the total stock market value and divide it by the GDP of the entire United States. Sounds high, and it definitely looks it when you check back on the long-term chart. And if we just go back to 2022, it was over 200% for a while. So really, we should have just been paying attention to this one and then decided just to either sell everything or wait for a while before we started investing. So everything I've said makes logical sense, and you can see why by looking at something like this, you might be scared and think, well, things are definitely too expensive and we're about to head into a recession, so buying stocks now is a terrible idea. Better stay in cash. The problem is there's a few points we need to speak about when it comes to this data in particular. Firstly, GDP can't take into account any business done internationally. So in this digital world that we find ourselves in, where lots of leading companies in the US now do a lot of their business all around the world, this becomes a lot less of a useful tool. As it stands, the companies that make up the S&P 500 at least do around 40% of their business outside of the US. If you just think about some of the big players, you can easily see how that's the case. Companies like Apple selling their devices everywhere. Microsoft is pretty much a key part of every major business, no matter what country you're in. And then Amazon sells their stuff wherever they can as well. So going back to the numbers, it would make sense how in the days before the boom of online businesses and technology, say before the 2000s, that GDP might be a bit more useful as a lot of companies only did business inside the country. If you're ever interested, it's funny to see how much the companies that make up the S&P 500 have changed just in the last couple of decades. Where it's now dominated by technology companies, it was actually before a lot more industrial with railroad, oil businesses, consumer staples, you name it. And a big reminder that things do and change very quickly. This then leads on to the next problem. The chart doesn't take interest rates into consideration, and it isn't showing us what the rest of the market is doing. So whilst this one is a bit more technical and a little boring, I'll just keep it simple and say that when interest rates are high, this means that you can get returns by buying bonds instead of investing. And then on the flip side, when interest rates are low, as they have been for more than a decade before those recent rises, there's been better returns to be had investing in the stock market, as savings rates from banks and government bonds haven't delivered anything at all. Not to mention the fact that central banks have pumped huge amounts of money into the system too, another thing that isn't showing in the chart. Unfortunately, there's no button to add the money printer, but we can still use the meme because I think it never gets old. So useful to look at, yes, but just be very careful making big calls from it, and you might want to be careful comparing different timeframes, as you're not really comparing apples to apples, and many more variables would definitely be important to look at. Also, GDP and the stock market aren't measured in the same way, so we do need to be really careful too. You've got GDP as a backwards looking, and it's just a fixed amount that represents one total year, whereas the stock market is a forward looking beast which reflects going on to the future pretty much indefinitely. So funny enough, right now the chart actually says fairly valued, even though on paper it looks high, and that's because the trend line is up, and you only have problems if you use a flat line and try to make an average. Anyway, you can see how you can say pretty much whatever you want, and if you were a short seller or a massive bear, you could easily scare people and convince them all to sell. Next up, Robert Shiller's CAPE ratio. This one's a really powerful one that was made famous back in the dot-com bubble. And the idea of this one is that you take your PE ratio, one of the most basic metrics for an investor, the ratio between the price of a stock and what it earns, in other words, its profits, and then in this case, average that out of the previous 10 years, and then you see what you get. Now, by doing that, you smooth out the big changes that can happen at any one point, because let's say you invested in a company that was $10 per share, and they made $1 per share in profits. Now that would be a PE ratio of 10. Now, if 6 months later their share price jumps to $20, their PE ratio now becomes 20. So you can see how that could be a problem in any short period of time. So it's much better to do that over a longer period. Now let's see what this one's saying. If we see big numbers, that will have to mean bad, and small numbers are good. At least that's what we can assume. Right, so at the moment it's up at 29.59, not quite up at all-time highs, but still if we take that over the long term, that definitely looks high. Going back over more than a century worth of data, we can see that the average has been 17 and the median average around 16. So does that mean that the stock market is nearly 2 times overvalued where it should be, and we should just sell everything? Well, not quite so fast. I think just like the previous one, got to be really careful when you're comparing different time frames because we're not necessarily comparing apples to apples. At the moment, the top companies in the world are technology companies, and they make far more profits than the oil companies and the car companies who used to dominate the stock market. Also, they've grown faster and they have a product that they can actually scale a lot better too. So my question to you then would be, do you think a company like Apple should therefore be worth more than a company like a Walmart or a General Motors, who funny enough used to be the number 1 and number 2 most valuable companies back in 2000 on the S&P 500. Walmart has some huge revenues, but their profit margin, once you take out all of their costs, is only around a couple of percent. Now compare that to Apple with a gross profit of 45% and then a net profit of around 25%. Pretty much 10 times more valuable for every dollar that they take in. Also, another point, remember how on the previous chart on the Buffett Indicator that the average line was trending upwards? Well, why aren't we using the same technique here? I mean, after all, we'd expect the companies today that would be far better businesses than the ones in the past. So how can we really compare them? It would be like comparing the best athletes of today versus the one many decades ago, or trying to compare a typewriter to a laptop. One thing always worth reminding yourself is that the companies in the S&P 500 are always going to change in and out, with the worst performing ones replaced with better companies, and this is all just a natural part of the market as companies change and innovate. Now, this doesn't mean that I'm trying to argue that stocks are not undervalued or overvalued. In fact, I think that's the wrong question to even ask. Now, the Shiller PE ratio has been a useful tool in showing us that when the market has a low ratio, it's tended to perform with higher returns in the future when compared to investing when the ratio is super high. And that's shown by this graph here, which is a bit of a pain to read, but essentially it shows what I've said, that investing during a downturn has tended to have better results over the next few years. Now, I just said that the question about whether the market is overvalued or undervalued is the wrong question to ask. So let me just explain what I mean by that. Data like this is definitely valuable to look at, there's no doubt, and especially important if you're trying to pick individual stocks and then trying to get a feel for the kind of market that we're in. If the market looks cheap, you're probably going to find more bargains out there. And if the market looks pricey, you want to be maybe a bit more careful and make sure that you aren't picking really expensive stocks and also getting carried away with FOMO. You might want to be more patient or switch to other assets like bonds whilst that market cools down. And likewise, you could say that if the market is depressed, you could also double down with buying index funds too, if you could invest more than just those regular amounts that you do anyway. All useful bits of information that could help you with your own strategy, whatever that is. And remember, please always do plenty of your own research because I'm not a financial advisor, just sharing my own thoughts. The problem I think comes in when you look at the data like this and think, right, I'm not going to invest at all and I'm just going to wait until those numbers just hit a certain target. And I think this way of thinking is worse if you're a long-term investor because now you're trying to time the market, and I'm now specifically talking about the market as a whole, not just individual stocks, because you might find a company at a great price in any market. What I'm saying now is that if you're looking to get started investing or you're still quite new, making a decision to start or stop investing because of data like this or another random indicator is going to be pointless. There'll always be something out there which is flashing red and making you worried, whether it's inflation, interest rates, wars, or whatever else is going on out there. If you're a long-term investor and sticking to using broad market, low-cost index funds, which I talk about loads on this channel, then it's best to avoid all this news and continue on whatever plan you have. As per usual with investing, it's not necessarily just the market that controls our returns and how much money we can make, but actually it's how we react to things in the news and our own actions. Now, unfortunately, as much as most people watching are probably a bit more clued up than most, It is true that retail investors like me and you way too often buy on the way up, sell on the way down, meaning that we miss out on most of those long-term gains, often lose to the market and waste too much of our lives focused on returns, when actually we'd be much better off trying to make more money from our day jobs and focus on saving money to actually invest in the first place. So the real question isn't whether the stock market is overvalued or undervalued, it's why do you want to know and what action will you take if you could know the answer. And for most investors, as history has shown us time and time again, the best way forward is to just do absolutely nothing and stay the course unless you invest in a company that's never made a profit and is going to go out of business. Then it might be a time to take some action before it goes bust. So for me, as always, I'm going to continue to invest as much as I can, as often as I can, into mostly index funds with the goal that I won't be touching that money for many decades. And also make sure that I make the most of my stocks and shares ISA, and more to come on that topic very soon. Anyway, if you're still worried about whether it's a good time to invest, here's a video I did recently talking about this exact topic that you might like. Or if you haven't seen it yet, here is my complete beginner's guide to investing, which I updated recently for the year, taking you through everything you need to know from start to finish. Enjoy the next video. Happy investing.